Some people think $20,000 is just a number, a price tag, a line on a chart that gets crossed and forgotten by the next news cycle. But every time an asset has smashed through that particular level in modern market history, something strange has happened afterward. The behavior of everyone involved seems to flip. The cautious get greedy, the greedy get careless, and the people who were right for years suddenly start looking wrong, right before they turn out to be the only ones who were paying attention. So here's the real question tonight. Why does crossing $20,000 seem to change the psychology of an entire market, and what happens in the months after that most people completely miss? 3 things are worth sitting with before we go further. First, why does a round number with no real mathematical significance seem to unlock a wave of buying that fundamentals alone can't explain? Second, who actually benefits in the weeks after a threshold like that breaks, and who ends up holding the bag? And third, what is it that the early, boring, unglamorous investors understood that the latecomers, the ones who show up after the headlines, almost never do? To answer that, we need one mental model, and we're going to come back to it more than once tonight. Think of a snowball rolling downhill. At the top of the hill, it's small, it's slow, and almost nobody notices it. Halfway down, it starts picking up speed, and a few people notice, some get in front of it, some get out of the way. But near the bottom, it's not just fast anymore. It's picking up everything in its path, and by the time the crowd sees it coming, it's already too late to get out cleanly. That snowball is what happens to price, attention, and behavior once a market breaks through a level that captures the public imagination. Keep that image in mind, because we're going to need it again. Now, before you accept the idea that $20,000 is just psychology and nothing more, ask yourself why psychology moves markets at all. Prices are supposed to reflect information, earnings, supply, demand, interest rates. But humans don't process information in a straight line. We process it in chunks, and round numbers are the chunks our brains are wired to notice. That's not a flaw unique to retail investors. Institutions build algorithms around round number thresholds too, because they know retail traders react to them. So the number itself becomes a kind of self-fulfilling trigger, not because 20,000 is mathematically special, but because enough people believe it is, and that belief changes their behavior, which changes the price, which reinforces the belief. Let's ground this in something real. In December of 2017, Bitcoin crossed $20,000 for the first time, and the reaction wasn't calm analysis, it was a stampede. Search interest for "how to buy Bitcoin" spiked to levels never seen before. Late-night television hosts were joking about it. Your coworker who'd never mentioned crypto in his life suddenly had a wallet. And then, almost as fast as it arrived, it reversed. Within about a year, the price had fallen more than 80%, down into the $3,000 range. The people who bought because the number, 20,000, made headlines were, in large part, the ones left holding the loss. But here's where most people stop the story, and where they get it wrong. That crash wasn't the end of the pattern, it was only the middle of it. In November of 2020, Bitcoin crossed back above $20,000 again, and this time something different happened. Instead of an emotional retail stampede, it was accompanied by public companies quietly moving treasury cash into it, and asset managers filing paperwork for regulated investment products. The second time a market crosses a psychological threshold, the composition of the buyers tends to change. It stops being purely a crowd chasing a headline, and starts being an early wave of institutional money that had been waiting on the sidelines, using the confirmation of that level holding as their signal that it was safe to move. That's the part worth translating into something graspable. When institutional capital, pension funds, insurance companies, asset managers, starts allocating billions of dollars into an asset class, that's not pocket change. Even a small single-digit percentage shift in how large asset managers allocate money can represent tens of billions of dollars moving at once, more than the entire market capitalization of many well-known public companies combined. That's the scale we're talking about once the number stops being a retail talking point and starts being a professional benchmark. We've seen the same shape before, outside of crypto entirely. Go back to the late 1990s, and the psychological number wasn't a price, it was a story. The idea that the internet would make traditional valuation math obsolete. The Nasdaq index doubled in roughly a year on that belief, fueled by retail investors piling into anything with .com in the name. Then in 2000, it lost roughly 78% of its value over the following 2 years. But underneath that crash, the infrastructure that survived, the fiber optic lines, the data centers, the payment systems, became the backbone that companies like Amazon and Google built empires on top of a decade later. The crowd got the timing wrong. The pattern was still right. That's the psychological trap that's easy to fall into, assuming that because a crowd got the timing wrong once, the underlying trend was fake. Loss aversion makes people remember the crash far more vividly than the recovery, so an entire generation of investors avoided tech stocks for years after 2000, and many of them missed the actual wealth creation that followed. Fear doesn't just cost you in the moment, it costs you in the years after, when you're too scarred to get back in. There's a third precedent worth putting next to those two, because it shows the same pattern playing out in something much more mundane than crypto or tech stocks: housing. In the years leading up to 2008, home prices in the United States climbed past levels that, on paper, made no sense relative to average household income. But the psychology wasn't, is this house worth this price? It was, prices only go up, so waiting to buy means losing money forever. That belief pulled in buyers who normally would have stayed on the sidelines, and it pulled in lenders willing to approve loans they wouldn't have touched a decade earlier. When home prices nationally outpaced wage growth by a wide margin for years running, the reaction wasn't caution. It was urgency. And when that urgency finally broke in 2008, U.S. home prices fell nationally by roughly a third from their peak, and the fallout didn't stay contained to housing, it dragged the entire financial system down with it, because so much debt had been built on the assumption that the number would never stop climbing. What ties Bitcoin in 2017, the Nasdaq in 2000, and housing in 2008 together isn't the asset. It's the sequence. A number gets crossed that captures public attention. The crowd piles in, not because they've done the math, but because everyone else is doing it, which is really just a bubble in its most basic form, buying because the price is going up, rather than because the underlying asset justifies the price. The number becomes a story before it becomes a fact. Then reality reasserts itself, often violently, and the people who ignored the story and looked at the fundamentals are the ones left standing afterward. Let's bring the snowball back for a second, because this is where it matters most. The snowball doesn't stop being a snowball just because it hits a bump and breaks apart. The mass that was in it gets redistributed, some of it melts, some of it gets picked up by a new, bigger snowball rolling right behind it. That's what happened with dot-com money flowing into the eventual FANG dominance. That's what happened with the first Bitcoin crash feeding into the institutional wave that came later. Each time a threshold breaks, gets tested, and breaks again, the buyer base tends to mature, moving from purely emotional, headline-driven capital toward more structural, long-horizon capital. There's a Fed angle here too, and it explains part of why even more tends to happen after a threshold like this. When interest rates are low, holding cash or bonds pays you almost nothing, so capital goes hunting for yield anywhere it can find it: real estate, tech stocks, emerging assets. When the Federal Reserve raises rates, that hunt slows down, because now just parking money in a savings account or a treasury bond pays a real return. Every major psychological breakout in modern market history has occurred against the backdrop of a specific rate environment, and understanding which direction the Fed is leaning tells you whether the snowball has room to keep rolling, or whether it's about to run into a wall. Think about it like a sprinkler system for capital. When rates are near zero, it's like the sprinklers are running constantly, and money has to go somewhere, so it spreads out into every corner of the yard, including the corners that don't really need the water. When rates rise, the system gets turned down, and the water only reaches the areas that actually justify it. That's why the years around near-zero rates tend to produce the most dramatic threshold-crossing rallies, and why tighter rate years tend to be when the excess gets wrung back out. It's not that the Fed is deliberately targeting any one asset. It's that the cost of holding cash instead of taking risk changes the math for millions of investors at the same time, all at once, which is exactly the kind of coordinated shift that turns a slow-rolling snowball into an avalanche, or grinds one to a halt. So let's go back to the hook. Why does everything change even more after a market crosses $20,000? Because the first crossing filters out the fastest, most emotional money, the people chasing a headline, and in doing so, it creates the crash that scares off the crowd. But the second crossing, the one that happens after the crash has already taught the market a lesson, tends to attract a different, more patient kind of capital. That's the snowball picking up mass that isn't going anywhere, instead of mass that melts at the first sign of trouble. The lesson here isn't, buy whatever just crossed a round number. It's that the reaction to the number tells you more than the number itself. Watch who's buying, not just what the price is doing. A retail-driven spike built on headlines behaves completely differently than a slow, quiet accumulation by capital that doesn't need to check the price every hour. One is a stampede. The other is a snowball that's been rolling for a while, and just happens to be visible to the rest of us now. There's also a quieter lesson buried in here, one that has nothing to do with charts. Every one of these thresholds, 2017, 2000, 2008, produced two very different groups of people in hindsight. There were the ones who treated the number as permission to stop thinking, and just followed the crowd because the crowd felt safe. And there were the ones who used the number as a prompt to ask harder questions. Who's actually buying this, why now, and what happens if the story stops being true? That second group didn't always get the timing perfect either. Nobody does. But they were the ones who survived the crash with enough capital, and enough confidence, to still be in the game when the next snowball started rolling. If there's one thing worth taking away, it's that markets rarely change because of a number. They change because a number changes who's paying attention, and by the time everyone's paying attention, the early money has already moved on to the next hill. The question worth asking isn't whether $20,000, or any other round number, is magic. It's whether you're the one still watching the snowball once the cameras have stopped.